right, today we're talking about the inheritance of a variety of different assets. And if you're not careful, the tax implications that you pass on to the next generation or the beneficiaries of your estate can be tremendous. So, we're going to talk about some of the details of transferring your assets onto your beneficiaries and trying to avoid the IRS becoming your number one beneficiary, right? So, where should we start?
What are the two certain things in life? Death and taxes, right?
Taxes. Yeah, exactly.
That's right. Right. Well, I think this is a good conversation because it's where the rubber meets the road. A lot of people, they've done planning, they've been thoughtful. Ideally, they put in a trust, they've thought about inheritance and all those items. But now, there's a moment where they've passed away and the next generation now has this, ideally, large buffet of things they have to deal with. And some of it
gives you that sense of the variety of different assets. Yep. Love it.
Yeah. Some of it is, couldn't be straightforward. A lot of it is not. And there's some pitfalls. And ideally, if the first generation has done the right steps of having a trust, doing things as we would want them structured, it's very doable. It just becomes a question of what's next. And part of this came out, we had a client a couple of years ago that the wife's father had passed away and she received a decent inheritance. And there was real estate, there was some annuities, there was some K type assets, and there was a stock account. And she received them all. And this is right when we started working with her. So she had already made some choices and sent in some documents before we started working with her. And then we kind of amended from there and went forward. But it was a reminder for us of, when this first happens, even with all the best planning, there's still a lot to be done and a lot of questions. It's a good moment to have an advisor. So we kind of walk through some of those things you should be expecting, things you should have on your radar to start planning for now. So we can jump into the first one. It's just a good old fashioned stock account. So you have a stock account. It's built up over the years. There's a lot of gain in there. A lot of people already know from previous episodes that you get this thing called a step up in basis. Wow.
It's like one of our favorite things to talk about because it's so beneficial. So it's
it is, and you want to make sure that you plan for it, right? I mean, it's very important that if you have some wealth, you want to make sure you do that properly.
Yep. We're talking about after-tax money that's been invested in the stock market. So it could be a variety and it could be multiple accounts, right? In her case, she had multiple accounts that she was inheriting.
Yeah. So as a simple example, you buy a share of Apple stock for $100. It's gone up to $150. Wonderful. Great. It's gone up. If you were to sell that stock during your life, that difference, that growth, that $50 is taxable. It's capital gains taxable. That's what most people expect. Well, at the time of death, that cost basis, that $100 you initially paid for that stock, it gets elevated all the way up to the fair market value at the time of your death. Those capital gain taxes that were built in there, they disappear. Very few places in the tax code do taxes go away. Usually they defer or they get delayed. But in this instance, they actually go away because of that step up in basis. And so the idea being whoever inherits that from you the day after, if they have that step up basis, they could, in theory, liquidate that account and have zero taxes.
Now, in reality, they don't receive that inheritance the day after death. And so sometimes there is still some confusion. Our clients will say, hey, wait, but I'm still getting a 1099 for some gain or loss on this account. And that's because by the time they actually receive the asset, it's calculated as of the date of death. So the actual asset itself will still fluctuate up or down, and you will have those tax implications. So that's kind of the expediency of trying to get the account in the case that you want to rebalance or change the holding or the asset allocation, because at that point you're essentially at kind of a tax neutral basis.
Yep. That's so good. And the first thing, and this happened in this instance, is the first thing that happens is you notify the custodian, Fidelity, Charles Schwab, whoever's holding the account, that the individual has passed away, and they will start doing the step up in basis. We've had clients in the past that, I guess before they were clients of ours, but before they processed the step up in basis, before the custodian updated their records, they went ahead and sold the account and said, hey, we get that step up in basis, no more taxes. Let's just sell that Apple stock and move into something different. Well, even though they are technically right, they still get the step up in basis. It wasn't processed. And so the 1099 that's going to come out, that tax reporting, is going to show all these gains. And it's going to be a fight back with the custodian, back with your tax preparer to get that fixed. So one of the items that we talk about is, before anything's traded or done, there should be this kind of administrative process of submitting a death certificate, making sure the custodian updates the account. It's simple. However, it saves a massive headache down the road.
And I mean, I think this is just a good, practical reminder that after the date of death, go ahead and get multiple copies of the death certificate because that's the proof of verification that you'll be sending to these different custodians. And so, yeah, make sure that they keep an accurate accounting of the date of death so that it doesn't become confusing when it comes to tax time at the
Yeah,
end of
For
the year.
sure. For
that's
sure.
right. And Randy, I'll send this next one your way because you've walked through this. Is sometimes someone will pass away and they've got losses. They've got losses built up, and do they go away? Do we have to use them? We've had clients that didn't know what to do. They say, "Hey, mom and dad actually had $50,000 of losses in this account. I'll just hold on to those. I'll just wait and use those later." What do we have to deal with in that situation?
Well, again, in that situation, the date of death is a critical time, right? And so everything gets revalued at that point. The losses pretty much hang out. I mean, they just kind of go away. You really can't use them. It's during your lifetime. Again, the capital gain, whether it be short term or long term capital gain, that's for the people that are alive. And so when losses are accumulated, that's why you want to stay on top of it and do your tax planning continually.
Hmm.
And the older the client gets, of course, we never know when somebody's going to die, but you want to make sure that you're handling those in an appropriate manner because those benefit, not only the current client, but also would benefit the inheritance to the family. So
Beneficiaries.
yeah,
That's right. And we had a client that had meaningful paper losses that we were, as they were aging, trying to use those up, trying to make sure that they were utilized during life so that it didn't get lost in the shuffle as we move forward. That's
Let
great.
me just pause here too, because we're talking about all different assets and we're going to continue on talking about this, but the organization that is so helpful ahead of time. So in the client scenario that we're talking about, there was another sibling that kept a real accurate record and kind of a list because we're talking about broad buckets. We're talking about a brokerage account and we're going to talk about qualified accounts, right, et cetera, et cetera. But there was multiple accounts under each one of those categories. And, there's many people, clients that we have and have had for years that all of a sudden they'll say, oh, yeah, I have that tiny itty bitty pension from this old employer that I had years ago. So trying to stay organized and have a resource. We have a planning software where we keep all of that organized for our clients. But even if it's a simple Excel spreadsheet of like what accounts you have and where they're being held, count numbers, right? All those basics. So at least there's like kind of a point of reference for them.
for sure.
Well, the other one we'll talk about with step up before we move on to the other items. People understand this idea of a step up in basis. They're planning on that for the inheritance. We just talked about stock accounts. The other big one is real estate, especially if it's either commercial or some sort of a residential rental, properties that you're not living in. Those get that step up in basis. And it's so powerful for the next generation. But one thing that we always have to make the caveat, we're here in California, and California, like so many other states, is a community property state. I think there's 9 community property states. Most other states have different ways they treat property between spouses. And so, for example, Colorado is not a community property state. If two spouses were to pass away, or two spouses, if one of them passes away, that one spouse's 50% would get the step up in basis.
And
Maybe
the other 50.
the other one doesn't. So maybe half the taxes go away at the first death, but the second one doesn't. And the second person's death, there might be a different step up, but there's still some tax benefit
And
or
I mean,
issue coming to the kids.
yeah,
Mhm.
and staying on track of the calculations, the valuation, the appraisals, all those things. That can be a nightmare if you have multiple properties and you've got anyway.
So essentially what you're looking for is a calculation of the fair market value of the various assets, especially real property, but all the assets at the date of death.
Yep. And if you try and look back and do that, it gets a little difficult for the stock market. If things are publicly traded, you can go back and find that historic data pretty easily. For things like real estate, that's kind of unique. It's tough if you haven't done a valuation at the time of death. In California and the other community property states, if you have two spouses and one passes away, you get a full step up in basis, 100% step up in basis. So it makes it a lot easier. You still want to get that correct value, but you're not going to have multiple moments of getting the step up. So we've had in California a number of folks who say someone passes away, a widow now has a couple of rental properties they've had for decades. All of a sudden, there's this change in the sense that all those taxes just disappeared, and they have to decide, the widow or widower, do I want to keep them and keep that rental income, or is it a good moment to now liquidate these and
Okay, so
simplify my life?
I'm going to put you on the spot here. If it were to be that the deceased person held property, real estate in Colorado and in California, what would be the tax
Ancillary.
at the time of death?
Dun, 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 dun. Yeah. I always love it depends, right? There's some specifics of when was the property acquired, pre-marriage, after marriage, where are they living now? All those things would play into place. I mean, without looking up, I want to look at that one up, but generally, I would say the state in which it's located, that's what that local authority is going to treat it as.
Mm-hmm.
However, that being said, there are folks who have California assets and they just invest out of state, right? There's
Yeah.
arguments of how that should be treated, but it gets just as I alluded to, like it can get complex real fast. It can also be very simple, right? When you get the right answer and say, "Oh, we get a step up," all right, let's move on. Versus, like you said, there could be some real hard questions.
Yeah, I mean, there's clients that we're dealing with right now that are receiving um, payouts from companies they work with, and so they want to make sure they get treated in a tax state, that's favorable to that.
Mm-hmm.
And we've had multiple clients that look at that, and we say, go talk to your CPA. Let's take a good hard look at it, because if you don't declare the taxes, California potentially could come after you. There's been a lot of cases where they've
Hmm.
gone after like professional athletes and such as that, where they receive their money and interpretation of how that is received and where it's subject to be taxed. And so people, you're making a decision to try and avoid the California state income tax. And I've seen where clients, at the end of the day, they make a decision. No, we're going to declare it in California just so that we're not going to be looking over our shoulder and making sure that they're not tracking us down. Others take the risk and say, nope, I've established my residency. I'm out of state. This money came to me when I was in a favorable tax state. And again, the decision is the client, but there is that risk. There is that potential that if you're saying I'm not going to pay that tax in California, they could come back and audit you and they could take you to tax court, right?
Right,
Hmm.
exactly. No reason to hide anything. Make sure
Right.
everything's properly calculated for, and always try to err on the conservative side is probably a clear recommendation there, just in
That's
case.
right. That's so good.
Let's talk about some of the other assets that they inherited. There was an annuity. Let's talk about kind of the structure of an annuity.
Yeah. So unlike, and then as we walk through this, annuities specifically, often annuities is by a contract, and there's this good income that was for the parent's life. They're probably receiving some income for it. It's real stable. It was probably a good part of their portfolio. Now they've passed away. Unlike stock accounts and unlike real estate that got that step up in basis, annuities do not get a step up in basis generally. And so very often all the tax that might have been built up in that annuity account, when the children, take that on, whatever that taxable situation is to the parents, they're probably going to receive that as well. And so that's, in my mind, it's a medium, medium good. And it depends what went in. Was it non-qualified? How much gain is there? It's kind of a mixed bag, I guess. And
Yeah, and
so,
I get annuities. There's a variety of different annuities. I mean, I don't want to take this space to talk about all the differences in that. If it's an IRA, for example, they change if you're a non-spouse beneficiary. It was before, I forget what year it was, but the tax was that you could take the participant's mortality schedule, so stretching out the payments to you for a long period of time. They changed all that. They said if you're a child or a non-spouse beneficiary, the maximum timeline, it can be anywhere. Well, we've had it where the maximum timeline is 5 years, but generally speaking, you can take it out over a 10-year period. And there's been a lot of case studies and court decisions regarding that. You can't, anyway. With all
mhm.
that
And there
said,
can be
you got to know what you're doing. You got to know what
Yeah,
you're doing
and
in there.
there can be situations where you inherit an annuity and it hasn't been annuitized yet, meaning like the faucet hasn't turned on, the income hasn't started coming out of the annuity, and that's going to have different implications as well. We oftentimes, when we're communicating like the structure of an annuity with our clients, we refer to it like an insurance policy, in that it's kind of like a fixed income benefit, almost like a pension replacement for a lot of our clients. However, but when we're talking about it in the context of passing it on to your beneficiaries, it has a different tax treatment than an insurance payout. And so now toggle to the next asset, there was a life insurance benefit, right?
Mhm.
That was paid out to the various beneficiaries. Now that is not taxable, whereas the annuity benefit paid out over however many years is determined is taxable. And what schedule you have to take that distribution, there's different rules that apply to that.
Yeah, it can get real sticky real fast, and people have an understanding of what it is, and then it ends up being something different. And tax laws change, right? There's
Tax
all
laws.
this, everything's dynamic, everything kind of moves. And
This is a great reminder too, like for our client, they had a CPA that they had worked with for years and their tax filing was pretty, let's call it vanilla, pretty simple until this moment. And then it became really complex. And in that year, they were considering, can we still work at the same CPA or do we need somebody that can deal with this level of complexity? Because so anyways, it might be also a good time to kind of refresh your relationship with your
Yeah.
CPAs.
Even if it's just a short term of like, I just need for the next year or two, I need much higher level CPA that can really, guide me through this, knowing that 3 years from now, I might go back to the same person again. But knowing for those years, there's complexity. So we talked about, stock, real estate, talked about annuities, a little bit about life insurance. And now we're kind of at the other end of the spectrum is these qualified accounts. So things like a 401k or an IRA, this, mom and dad were receiving their distributions. They were living off of these accounts, but then they pass away. So that account is now being inherited. And that account, that money, when you think about it, it was never taxed initially. It was put into the account tax deferred. It grew for many years tax deferred. And now that's transitioned to the next generation. All those taxes are still built in there. So all that money, when it does come out, is going to come out as ordinary income. We're not even talking about capital gains. This is ordinary income, your normal tax brackets. And the benefit is you're receiving this asset from your parents. How wonderful you've inherited it. But as Randy was saying, there's some rules of either 5, or most often 10 years. You have to use that account up. But everything that comes out is going to be treated as ordinary income. And it adds on top of what you're already making. So a lot of people in their 50s and 60s are in high earning years already. And now they get this inheritance, which adds on top of that. So the spectrum can go from tax-free, step up in basis, partially taxable, all the way to fully taxable as ordinary income. And to a beneficiary, we said at the beginning, like a buffet. You have a buffet of different things you've inherited. You may not know immediately, just look at it. Those are all going to be treated tax-wise differently as they flow into my household. But they will. And Laura, you made a great comment, which is it's not usually, always, but it's not usually just one person. It's a couple of siblings. And so they're
In
receiving.
different states with different tax treatments. And so even with our client, we were comparing RMDs. And she said, well, this seems to be different than what my brother communicated, right? And so there was some clarifying that we had to do. RMDs, I mean, we're at the end of the year. So maybe to some of our listeners, this is top of mind as it is for our office. We try to calculate and make sure we've got all those RMDs I dotted, T's crossed right before the end of the year. But in the case of inheriting a qualified account, there's a lot of various rules that apply. Number one, there's a distribution rule if it's an inherited account that you need to empty that account typically within 10 years. The answer is sometimes it depends on who the beneficiary is and their relationship to the original account owner. But then in addition, if the original account owner was of RMD age and already receiving RMDs before they passed away, then additionally, you need to keep up with those RMDs. Now, the schedule and the amount of distribution will change based on the beneficiary, but there's two factors at play. Sometimes that calculation can get confusing. And so you have both the RMD and the distribution schedule based on the inherited qualified account too.
Yeah.
So
There you go. We just walked in a little bit of deep water, but people who are doing with RMDs, like this is something that is just top of mind. Some of our office does all the time, but Laura, you've had to walk through that with a number of clients of just making sure that they understand what needs to happen before the end of the year. Because if you miss an RMD, there's penalties. If you fail to take the right amounts, the IRS would assess penalties on that. So.
well, and there were some waivers in place. So for our listeners that should know, because we did take some deep dive on this recently with a few of our clients, but there was a law put in place in 2020. There were some waivers offered for the subsequent years regarding the RMDs. For an inherited account. And now in 2025, there will be penalties offered if you don't take
yeah,
it.
and I think
Rules.
I'm not advocating that people not take their RMDs, but in those instances where I've had clients where for whatever reason they just mistakenly did not take their spouse's RMDs when they inherited an IRA, and as soon as it was discovered, we calculated the required minimum distribution that they should have taken and declared it. I've talked to my CPA, who I've had a long-standing relationship with. He's never heard of, nor has ever experienced the penalty to come back. So really the key issue is once you discover that you need to take your required minimum distribution, take it, pay your taxes. And even if you're after the date, because the penalty, frankly, is declared as 50%.
Right. It's significant.
It's a hammer.
Yeah.
I've never, again, once you discover that you should have taken an RMD, take it, declare your taxes. IRS will probably leave you alone. But it is a threat that they could implement.
Now, QCDs, qualified charitable distributions, can you do
Yes.
that from an inherited qualified account?
If
That would
you're
be
there's guidelines. You got to be 70. It's got to come from a retirement account, and it should be done in January. A lot of people think, well, I'll just wait till the end of the year, do my tax planning then, make my gifts. Technically, again, I've never had the IRS come back and hammer a client because they took it out in December versus January, but a QCD should be taken out at the beginning
earlier.
of the year, and it goes to qualified charities and helps to reduce. And there's some other implications too of how it works with Medicare payments and all the other stuff. I don't think we want to take the space to get into that
Yeah, too
complexity,
many
but
details. But in the
right,
year where you're inheriting, like in this case, again, to go back to our case study where she's got lots of different assets and lots of different tax implications imposed upon her, some of which are unavoidable, right? Then we're starting to have some other tax strategy conversations that you don't want to wait until the end of the year to have, kind of like
right.
giving strategy, charitable donations to help offset the increase of tax. And so you want to be able to make those maneuvers ahead of time. And frankly, from our side, on the planning side, that we can liaise directly with our client's CPA to work out the finer details, come back to the client with some clear recommendations.
And
So,
the sooner you can do that, you don't want to wait till
right.
December 20th to do all this stuff, because oftentimes, first of all, the custodians that hold your accounts can't move sometimes quick enough to get all the documents in place. So you want to start on this. This should be something planned to be like the first part of December as you're working through. And that's what we're in the midst of that right now, because we're working through with a lot of clients to determine, do we establish a donor advice fund? Do we make charitable gifts? I mean, what are we trying to do right now? And there's a lot of players involved.
Mhm.
So, you got all these things, and all this documentation has to be done so that it's completed before December 31st.
Yep.
And
Yep.
people just think they can come in. Sometimes they think we can just snap our fingers and, oh yeah, it'll just happen. No, it
Right. And
takes some work, right?
a lot of thoughts to consider. What would the original account owner or the deceased individual, what would be their interest in the use of their assets? And then also as the person inheriting, how can this might totally change their lifestyle. This might have some huge implications. So it just depends. But a lot of those conversations take time to mull over and then come to a final decision. So, but I think we have, come to the end of our time. There's a lot more details here. Well, Jeremiah, why don't you summarize some key points that we talked about today?
Yeah, that's great. I think anyone who is inheriting from a parent, from anyone, there's a moment where you need to evaluate what you have, and knowing that different assets are going to be treated differently for tax purposes, and they have a different best use. So it's a really good moment to maybe upgrade your CPA, upgrade your financial advisor, make sure you have the right team around you to deal with those different assets that they can best be now deployed into your life. So it can be complex. It doesn't have to be, but just get the right support.
Yep. Love it. Thanks for listening.
Till next week, folks, may you grow in wisdom and knowledge.
We have a few more things to let you know about before we go. Podcast reviews really help us to serve more people and get this information into the hands of the people who need it. Please leave us a review. Even if it's not 5 stars, we welcome the feedback.
And we invite you to let us know what topics you would like to hear more about, or what would benefit the people in your life who you're closest to. We have more resources online. Those resources are designed to help you share this great information easily with people in your life. To access those resources, please visit tricordadvisors.com.
Often we hear from clients that they wish they had talked to us sooner. If that's you, we'd be thrilled to see how financial planning can benefit your life. Email us at contact@tricordadvisors.com, or simply click on the link in the show notes.
This show was produced by Graham Gardner at Model FA. Find out more about how to create a podcast for your financial planning business by visiting modelfa.com. We love creating content that's useful, resourceful, and maybe even a little entertaining. We want to make this mega universe of financial topics and advice applicable and helpful to your life.
Remember, at Tricord Advisors, we are your future's best ally.